The bank didn't make your money. That's the uncomfortable truth most people never hear. You wake up, you check your balance, you see the interest charge, and in your head, a simple picture forms. You borrowed money from a bank, you pay interest to the bank profits. End of story. But that picture is wrong, because in most cases, the bank is not the one keeping your interest payments. Not really. And once you see where that money actually goes, it changes how you see debt, power, and the entire financial system you're living inside. Let's start with a scene that feels familiar. You take out a loan, a mortgage, a car loan, maybe a business loan. The numbers look clean, a rate, a term, a monthly payment. You sign. The money appears. The bank smiles. It feels like the bank handed you its own money. It didn't. In fact, most banks don't lend out piles of saved cash sitting in a vault. They create new money when they issue loans, digitally, instantly, with a few keystrokes. That part alone already feels strange, but it gets stranger. Because the moment that loan exists, it becomes something else. Not a relationship between you and a bank, but a product. Think of your loan like a freshly baked pie. The bank didn't plan to eat it. It planned to sell slices. Here's how it works, step by step, without jargon. When you pay interest each month, that payment is supposed to reward someone for taking risk, for waiting, for trusting that you'll pay back. But banks don't like waiting. They like speed, turnover, certainty. So instead of holding your loan for 30 years, banks often bundled it together with thousands of other loans, mortgages, student loans, credit card balances. They package these loans into financial products and sell them to investors, pension funds, insurance companies, mutual funds, sometimes foreign governments. These investors are the ones who actually want long-term interest payments, slow, predictable, boring, exactly what retirees and institutions crave. So when you send your interest payment, the bank often passes most of it along to someone you'll never meet, someone who doesn't know your name, someone who might live on the other side of the world. The bank keeps a slice, a servicing fee, a margin, enough to justify the operation. But the bulk of the interest, that flows outward, quietly. This is why the system feels so calm on the surface. You think you're paying a local institution. In reality, you're feeding a global pipeline. And this isn't a conspiracy. It's not hidden. It's just rarely explained in plain language. Because once you understand it, another question appears. If banks don't really keep the interest, why are they so powerful? The answer is leverage. Banks control access, timing, rules. They decide who gets loans and who doesn't, at what rate, under what conditions. They act as gatekeepers between people who need money and people who already have too much of it. That position alone is enormously profitable. But here's where the math gets uncomfortable. Let's say you pay $1,500 a month on a mortgage. In the early years, most of that isn't paying down the house, it's interest. That interest flows to investors who already own assets, which means your monthly payment is helping increase the wealth of people who don't need a home, using money created when you signed a document. Irony doesn't even begin to cover it. And it doesn't stop with mortgages. Student loans, often owned by investment funds. Government debt, held by pension systems, central banks, insurance firms. Corporate loans, traded like commodities. Debt is not just money owed. Debt is an income stream. and interest is the fuel that keeps it alive. This is why interest rates matter so much, even if they feel abstract. When rates rise, money flows faster to those holding debt assets. When rates fall, that flow slows. Central banks know this. They don't just adjust rates to fight inflation or boost growth. They're adjusting how much money quietly transfers from borrowers to capital holders. Every decision ripples outward. But let's zoom in again, because there's another illusion here. You might think, okay, fine, investors get the interest, but the bank still carries the risk. Often it doesn't. Many loans are insured, guaranteed, backstopped, sometimes by governments, which means if things go wrong, the losses don't land where the profits went. They land somewhere else. Taxpayers, inflation, currency value. The cost is spread thin, quietly, over time. No bill arrives in the mail. And that's the brilliance of the system. It doesn't feel like extraction. It feels like normal life. A payment here, a statement there. But add it up across millions of people, and something massive is happening. A steady upward flow, from work to ownership, from borrowers to asset holders, from the present to the past. This is why people feel like they're running faster and staying in the same place. Why wages struggle to keep up while asset prices soar. Why owning things matters more than making things. The system isn't broken. It's doing exactly what it was designed to do. And banks are not the villains or heroes. They're the plumbing, the pipes that move value around efficiently. The real question is who designed the flow and who benefits from it continuing. Because once you realize your interest payments are feeding a much larger machine, it becomes harder to ignore the stakes. Every loan isn't just a personal decision. It's a tiny vote for how the economy distributes power. So the next time you see an interest charge, pause for a second. Ask yourself, who is actually getting this money? And more importantly, who built a system where the answer isn't obvious at all?